Have you ever watched mega cap stocks like Nvidia or Amazon just absolutely skyrocket, and you're sitting there feeling completely priced out of the action? I mean, dropping tens of thousands of dollars just to grab 100 shares of these premium tech giants? For most retail traders, that's just not going to happen. But what if I told you there's a way to turn those exact same high-priced names into your own personal income vehicles without that massive upfront cash? Well, that is exactly where the poor man's covered call comes in. In this explainer, we're diving straight into the ultimate capital-efficient solution. We'll break down a defined, repeatable playbook that lets you leverage these incredible market movers, even if you're working with a smaller account. So, here's our 5-step playbook for today. First, we'll decode the PMCC strategy. Second, spot the best candidates. Third, tackle the crucial math test. Fourth, structure the actual options trade. And finally, step 5, we'll cover how to manage your risk and returns. All right, step 1, decoding the PMC strategy, building synthetic stock. Let's get right into it. To level the playing field here, we need a way to mimic owning the stock without, actually buying the stock outright. And this setup has a brilliant dual nature to it. First, you lay the foundation. You buy a long LEAPS call. Now, LEAPS are basically just long-term options. You buy this contract deep in the money with an expiration way out there, 9 to 18 months out. This right here is your synthetic stock. It mimics the price movement of owning the actual shares, but it costs a fraction of the price. Pretty cool, right? Then you need your engine. You sell a short, near-term, out-of-the-money call against it, usually expiring in just 7 to 40 days. This short call is the secret sauce that generates continuous income. You are literally funding your long position by selling time to other traders. Now, you aren't out here swinging for the fences. The primary goal? Capture just 1% of the stock's overall price for 30 days of time. That's it, just 1%. But because this is a compounding strategy, if you execute this repeatable process, that 1% can compound into a guaranteed annual return of 12% or more, just from the income alone. And remember, that is entirely in addition to any capital appreciation you might snag on your long LEAPS contract. Okay, moving to step 2, spotting the best candidates, filtering for success. Listen, you absolutely cannot just apply this strategy to any random stock on the market. That's a recipe for disaster. We have to filter out those dangerous parabolic names and hunt for stable, highly liquid megacaps. We want steady growth, not crazy vertical spikes. So for trend quality, look for stacked and rising moving averages. Specifically, the 20-day needs to be above the 50-day, which sits above the 100 or 200-day. Simple enough. For momentum, we want a 14-day RSI between 50 and 70, and a weighted alpha sitting between 15 and 50 plus. Now, liquidity? Non-negotiable. You need over 10,000 in monthly options volume, tight bid/ask spreads, weekly expirations, and an implied volatility humming between 30% and 70%. And finally, look at the market cap. Target massive companies, over $10 billion. Why? Because these megacaps soak up huge passive investing capital inflows, and that naturally props up their stable upward momentum. Next up, step 3, the crucial math test, the 1/10 rule. So, even if a stock's chart looks absolutely flawless and passes every single filter we just talked about, hold up, we still have to run a strict mathematical test before risking a single dollar. By following these 3 simple steps, you make sure you aren't overpaying for time, and you prove that the income you're collecting actually justifies the premium you paid for the long contract. Here's how it works. Step 1, calculate the time premium of your LEAPS. Just take the price of the LEAPS contract and subtract its intrinsic value, which is just the amount it's currently in the money. Easy. Step 2, look at the premium you're going to collect on your first 30-day short call. And step 3, the ultimate pass-fail test. If the premium from that 30-day short call is less than 1/10 of the LEAPS time premium, you walk away. No exceptions. But if it passes, well, you've mathematically validated the trade. Which brings us to step 4, structuring the options trade, execution tactics. Once your candidate passes that math test, it's time to build the trade with surgical precision. These rules right here, they put the probabilities totally in your favor. First off, you want to buy your long LEAPS on down days. Buy it deep in the money with a delta greater than 0.70, though honestly, 0.90 is the ideal sweet spot. The higher that delta, the more it acts like a true stock replacement. On the flip side, you want to sell your short covered calls on up days. Aim for 14 to 21 days to expiration for that short call. The sources highlight this as the absolute sweet spot to maximize the premium you collect while riding that rapid theta decay. And finally, make sure to place your short strike at or above the expected move range or right at a level of technical resistance. Now, I know option Greeks can sound a bit intimidating, but stick with me. All you really need to remember is how they behave in this specific setup. Your delta is positive, which gives you that bullish exposure with a bit less sensitivity. Your theta is also positive, meaning you're literally generating income as time decays. Love that. But gamma is where your immediate risk lives. The short call has high gamma, so if the stock suddenly shoots up in a fast move, it rapidly changes the delta of your overall position, and that means you'll need to jump in and take immediate action to protect the trade. Let's head into step 5, managing risk in returns, the exit strategy. Okay, this is the most dynamic part of our explainer, actually managing the live trade like a pro. Recognizing a trend break is absolutely critical here. Remember, this strategy leans entirely on steady upward momentum. When that momentum fails, the setup is broken. And trying to defend a broken setup based purely on hopium, that is a fast track to disaster. So, how do we spot that break objectively? The sources call out 3 specific, undeniable technical shifts. First, a negative slope. If the slope of either the 20-day or 200-day moving average drops below 0% and starts pointing down, bearish momentum has officially taken over. Second, a price drop. The whole strategy requires the stock to stay above a rising 50-day moving average. If the price drops below that 50-day line, your trend quality is compromised. And third, alignment loss. Remember those stocked averages we talked about earlier? If the shorter 20-day crosses below the 50-day, or honestly, if they just stop rising together, that alignment is gone. If you see any of these 3 shifts happening, the advice is crystal clear. Exit the position entirely. Seriously, do not sit there trying to defend a loser. But wait. What happens if the trade goes against you in the other direction? Like, what if the stock rockets upward way too fast? Well, that triggers the gamma risk we talked about a minute ago. If this happens, you absolutely must actively manage the trade. You do this by rolling the short call up to a higher strike price and out to a later expiration date. Doing this is brilliant because it achieves 2 things at once. It maintains spacing above the expected move to prevent assignment, and it ensures your upside potential isn't capped, so you get to confidently keep riding that massive stock appreciation. On the flip side, when things go right and the stock moves exactly as expected, let that premium decay. But here's a massive trader's tip. Cover the short call when you've captured 80% to 85% of the premium collected. Just close the trade early. By securing the vast majority of your profit right then and there, you completely minimize the risk of a sudden, late-stage reversal wiping out your hard-earned income. Once you're covered, you just sit back, wait for the next optimal setup, and resell at resistance. I love this quote from the source because it perfectly sums up the mindset you need. It advises you to make your hand the first 10 months and don't obsess on collecting the last nickel. Your main goal is to aggressively recoup your initial time, premium, and your cost of capital. Why obsess over squeezing out every last penny when you could simply roll forward, stay disciplined, and start collecting fresh dollars? Ask yourself, why risk massive amounts of capital chasing pennies by buying shares outright? With discipline and a repeatable process, you can literally turn the market's most expensive giants into your personal ATMs. So, are you ready to stop watching from the sidelines?